Hey guys, so in this video I'll talk about stocks versus bonds, which I like for the long term now, and how that ties into current market valuations. So people have been saying since 2015 that markets are at all-time highs, prices are expensive, valuations are out of this world, but they forget that there's basically two investment vehicles in the markets. Again, in general, there's bonds, which is fixed income or low risk, even though I don't like those terms, and equity, which is high risk, and stocks. So over time, stocks have always outperformed bonds. Stocks have been averaging 7% per year over like 20 years or historically, and bonds have been averaging 2 to 4% depending on the risk that you take. That's been happening while interest rates were dropping for the last 20 years. Like back in the day, mortgage rates and all that stuff were in double digits, and now they're starting to increase. Well, most people don't know this, but bonds actually perform really well when interest rates go down, because if you're locked in at 15%, which I think I forget what year it was, but in the 80s you could buy a government bond that paid you 15% interest, according to Warren Buffett. So obviously at that point, well, stocks are more riskier. If I can get guaranteed 15%, I'll take it and I won't buy stocks. Well, today they're guaranteeing you basically 2%, 2 to 3%, which is very low. And now you're saying, well, that's not even inflation almost. Inflation is at 2 to 3%. I'm really not making money after inflation. So this drives up stock prices. People are willing to pay more for stocks now because they still average 7% over the long term. This means that now that those market conditions are where they are, that drives up the prices. So people are saying, oh yeah, now stocks are super expensive with where they are on an absolute level. PE ratios or market cap to GDP are at really high levels compared to the last 20 years on the US markets. But the interest rates, low interest rates, favor stocks. And especially now we have a really strong economy. I don't like making predictions, but I just know that long term, especially at this time, in the short term, if there's a recession, bonds might outperform, but I don't care for the short term. All your investments should be at least, you should be thinking for 5 to 10 years. If you don't plan on owning a stock or a fund for 5 to 10 years, don't even touch it. So basically, this is how valuations and stocks and bonds translate to the current market conditions. If you have a question, please feel free to let me know. Thanks.